Well, the current state of the equity markets can be quite scary for those of us who are retail investors. We know you must feel helpless watching all of that hard-earned money dwindle away in front of your eyes as the market indices fall lower and lower every week. So what should you do in a situation like this? We've put together a report that will help you restrict your losses and maybe even make some money in this downturn. Take a look.
It's been jolt after jolt after jolt, and the markets have officially gone into panic mode. The Sensex lost about 1,200 points in the last 3 weeks and even fell below 16,000 earlier in the week. And it is our very own currency that is playing spoil sport. The rupee has fallen almost 18% against the dollar from its peak in early February. It hit a record low of 56.4 to the dollar earlier this week.
The way the rupee has depreciated, it is going to affect the economy overall. Whether you're talking about the oil prices, whether you're talking about the fiscal deficit, and this will have the collateral damage on rest of the sectors. So because of which we are seeing the pressure on the markets.
But let's not blame the rupee alone. Greece's severe debt crisis and its possible exit from the European Union has spooked equity markets across the world.
The market is extremely worried about what's happening in Europe, particularly related to the Greece possible exit, because nobody really knows how the exit will be managed. There's a serious fear that there will be a contagion effect, and if that exit is not managed well, there can be a post-Lehman kind of a crisis internationally in the markets.
To add fuel to the fire, state-run oil companies hiked petrol prices again, this time by 7.5 rupees per litre. Petrol prices have risen more than 20 rupees per litre since January last year. While this means higher fuel costs for consumers, it might be the first hint of reform from a government that has been repeatedly accused of policy paralysis.
So this bold measure of increasing the fuel price by about 10% is really welcome relief for the market, because one, it shows the willingness of the government to be very realistic in tackling the economic issues, and two, definitely it would strengthen the balance sheet of the government. So both are positive for the equity markets.
So as a retail investor, what should you do now? In order to benefit from the current market scenario, you need two things: a long-term horizon of at least 3 to 5 years, and the ability to absorb a loss in case the market falls further before things start getting better. And get better they will.
Worst case scenario, I think maybe another 10-15% downside from here. But that is the kind of opportunity that is good for any long-term investor to participate.
The corporate sales growth still remains robust, anywhere from 20 to 25%. That is a big hope for Indian industrial economy.
Clearly, valuation-wise, the markets are attractive. And once the currency looks back, I suppose you'll have the FIs coming in, and that's the time you'll have the markets really bouncing back.
Now, if you are in the market for short-term gains, or you do not wish to take strong risks with your money, you would be best advised to sit this one out.
I would say that just stay put. Don't invest fresh at this point of time, although you may see that the markets are quite attractive.
Now, those of us who do plan to cherry-pick stocks at a time like this, here is a set of guidelines to follow.
Do not invest in companies with leveraged balance sheet. Do not or look for companies with strong corporate governance and reasonably visible cash flows. If you can watch these kind of companies, you will do very well over the next 3 to 5 years.
Again, you stay away from stocks like shipping industry and construction, because the pain is still left. There is huge overcapacity of ships. And in the construction also, if equity market is down, don't be under the impression that the construction sector will continue to do well.
Also, no matter what the state of the markets, make sure your portfolio is not restricted to equity investments. A diverse portfolio will help you offset your losses and maintain an overall balance in your investments.
Gold is a great hedge. It's not only to have in the portfolio only for returns perspective, but also as a hedge against inflation. So 5 to 10% of your portfolio should always be in gold.
Finally, while there might be the temptation to sell your stock holding and exit the markets altogether, liquidating now will have you walk away with heavy losses. Experts recommend you wait until the market shows signs of recovery before exiting any of your holding.